There's a quiet change coming to the IRS that most seniors haven't heard about yet, and if you miss it, you could end up filling out your tax return next year using outdated rules that no longer protect your money. I'm not talking about a rumor on social media or some scary headline that never materializes. I'm talking about an actual adjustment the IRS has already confirmed, one that directly affects how you report retirement income, how you handle medical deductions, and what you're allowed to keep in your pocket versus what gets taxed. If you've been doing your taxes the exact same way for the last 5 or 10 years, this is the year you need to pause, look at what's different, and make one small move before you file. Stick with me for the next few minutes, because what I'm about to explain could save you hundreds, possibly thousands, and I'm going to walk you through it in plain English, step by step, no accountant jargon, just the facts you need. Before we get into the details, I want you to think about how you usually prepare your taxes. Maybe you sit down at the kitchen table with a stack of papers, or maybe your daughter helps you, or you've been going to the same tax preparer for years. Here's the problem. The IRS does not send you a personal letter when they tweak something that affects seniors. They publish the change in a long document filled with technical language, and they assume that tax professionals will figure it out and pass it along. But a lot of seniors don't use expensive tax professionals. They use basic software, or they do it themselves, or they rely on a friend who's pretty good with numbers. That's exactly where the danger hides. You could be sitting there next spring, plugging numbers into last year's system, completely unaware that the rule has shifted beneath your feet. So what exactly is this rule change? Let me explain it as simply as I can. Every year, the IRS adjusts certain income thresholds, deduction limits, and credit qualifications for inflation. Most people know about things like the standard deduction going up or the income bracket shifting a little. But buried inside those annual adjustments is something specific for seniors that often gets overlooked. This year, the IRS has revised the way it treats what's called the additional standard deduction for taxpayers over 65. Now, you might be thinking I already know I get a higher standard deduction because of my age. That's true, and it's still there. What's new is the calculation of how much you can earn before certain benefits start to phase out, and how that interacts with things like Social Security taxation and medical expense deductions. Let me give you a concrete example so this makes sense. Imagine a married couple, both over 65, filing jointly. In previous years, they had a slightly lower threshold before their combined income started making more of their Social Security taxable. With this new adjustment, the IRS has changed the income floor for that calculation. I want to be careful here because I'm not saying Social Security is now taxed differently at the federal level. The percentages haven't changed. What has changed is the dollar figure at which those percentages kick in, because of how the IRS has redefined certain above-the-line deductions that seniors commonly take. If you don't know about this, you might accidentally report more taxable Social Security than you actually owe, which means you're literally giving money to the government that you could have kept. Now let's talk about medical expenses, because this is where the new rule really hits home for a lot of folks in our community. For years, you've been allowed to deduct medical and dental expenses that exceed a certain percentage of your adjusted gross income. That percentage has bounced around over the years, and right now it sits at 7.5%. That part hasn't changed. But what has changed is what the IRS considers an allowable medical expense for seniors who are using a portion of their retirement account distributions to pay for long-term care insurance premiums There is a new provision that allows a more favorable calculation of those premiums as a qualified medical expense, but only if you report it using a specific method that was not available in this same form before. If you use last year's software without updating your inputs, you might miss this entirely. I've seen this happen before. A gentleman I know from Michigan called me last year, frustrated because his tax bill was much higher than he expected, and it turned out he hadn't claimed a deduction for his long-term care premiums that he was absolutely entitled to. The software didn't prompt him because he answered one screening question incorrectly and he lost out on over $1,100. That's real money. That's a month of groceries. That's a couple of car payments. And that's exactly the kind of mistake this new IRS rule could cause if you're not paying attention. Let's pause for a moment and think about why this matters so much right now. We're living in a time when inflation is still fresh in everyone's mind. The cost of prescription drugs has gone up. Medicare premiums have adjusted. Your retirement dollars need to stretch further than ever. The last thing you want is to leave money on the table because of a tax filing error that could have been prevented with 10 minutes of education. And that's why I'm making this video, not to scare you, but to prepare you, so that when you sit down with your paperwork next tax season, you can do it with confidence. Let me walk you through what you should do differently when you file. First, do not assume that the standard deduction amount you used last year is the same. The IRS has increased it slightly, which is good news, but you want to confirm the exact number for your filing status and age. Second, if you're receiving Social Security, take a fresh look at the worksheet that calculates the taxable portion. Don't just trust the software to carry over your prior year settings. Manually review the income ranges, because the new threshold I mentioned earlier might mean that less of your benefits are taxable than you originally thought. Third, if you have any medical expenses, including Medicare premiums, supplemental insurance, dental, vision, hearing aids, or long-term care insurance, gather those receipts and total them up before you file. You may be surprised to find you exceed the 7.5% floor, especially if your income is lower this year. And with the updated rules, certain long-term care premiums that were partially limited before may now be fully includable. That is a huge opportunity. I also want to talk about required minimum distributions, because this is another area where seniors sometimes get tripped up. The age for RMDs has shifted in recent years, and if you turn 73 or 75 recently, depending on your birth year, you might be dealing with your first required distribution. The new IRS rule does not change the RMD age itself, but it does adjust the penalty calculation for missed RMDs in a way that benefits seniors. The penalty used to be 50% of the amount not taken. That was brutal. It's now been reduced to 25% and potentially down to 10% if you correct the mistake quickly. The key here is that the IRS has updated the forms and procedures for requesting a penalty waiver. And if you don't know about that update, you could end up paying a penalty that you could have avoided entirely. I'm gonna say that again because it's so important. If you missed an RMD or took less than you were required to, you can now request a reduction or waiver of the penalty using a new streamlined process that the IRS introduced alongside this rule change. Do not just pay the penalty and move on. File the correction correctly, and you might keep that money in your account where it belongs. Another part of this rule change that I need to mention involves charitable giving. Many seniors donate to their church or favorite charity, and some of you use what's called a qualified charitable distribution from your IRA. That's where you tell your IRA custodian to send money directly to a charity, and it counts toward your RMD without being included in your taxable income. This strategy is still one of the smartest moves a senior can make, but the IRS has tightened the documentation requirements. You now need a specific type of acknowledgement letter from the charity that includes language confirming the distribution came directly from the IRA, not from you personally. If your church sends you a generic thank you letter without that language, it may not hold up if you're audited. That's a new enforcement focus, and it's part of the same wave of changes I'm talking about today. The rule isn't about eliminating the benefit. It's about proving you've followed the exact steps. So when you make your qualified charitable distribution this year, call the charity and ask for the proper acknowledgement letter before you file. Don't wait until April and scramble. I want to address a question I hear often from people who watch this channel. They say, I don't have a complicated tax situation, so I don't need to worry about IRS changes. I understand why that feels logical. But here's the truth. The simpler your return, the more impact a small rule change can have, because you might not have a professional reviewing it. If you take the standard deduction, have Social Security income, maybe a small pension, and a little bit of interest from the bank, you are actually the exact person who benefits the most from knowing about these updates. You have fewer moving parts, so getting one part wrong hurts more, and getting it right means you maximize what stays in your checking account, which is exactly where it should be. Let me share one more real-world scenario so you can see how this plays out. Imagine a widow in Ohio, 72 years old, living on Social Security and a small IRA. She files her taxes herself using an online program. Last year, her medical expenses were high because she had cataract surgery and new hearing aids. She also started paying for long-term care insurance. The old way of calculating her medical deduction would have limited her long-term care premium deduction to a certain age-based cap. Under the new rule, the cap has been adjusted upward, and more of her premium qualifies. If she doesn't know that, she might only deduct the old capped amount, paying tax on income that should have been offset. Over the course of just a few years, that mistake could cost her thousands. Now imagine she watches a video like this, learns about the change, and fixes her return before she files. That's the difference between stress and security. Before I wrap up, I want to remind you that I'm not giving personal tax advice. I'm sharing information that is publicly available from the IRS, presented in a way that helps you spot opportunities and avoid traps. Always consult a qualified tax professional if your situation feels complex or if you're unsure about anything. But even if you do hire a professional, go into that meeting informed. Tell them you want to make sure your medical deductions are maximized under the latest rules. Ask about the new Social Security income thresholds. Ask about the reduced RMD penalty in the waiver process. A good tax preparer will appreciate that you're engaged, and you'll know that nothing was missed. So let's bring this all together. The IRS has made a quiet but significant adjustment that affects the additional standard deduction for seniors, the income thresholds for Social Security taxation, the deductibility of long-term care premiums, the penalty structure for missed RMDs, and the documentation requirements for qualified charitable distributions. None of this requires a law degree to understand. It just requires that you pause before you file and double-check that you're not using last year's playbook for a game that has slightly new rules. I've seen too many good people overpay simply because they didn't know. You now know. So take a breath, gather your receipts, update your software, or talk to your preparer, and file with confidence knowing you've done everything you can to protect your hard-earned money. If you found this breakdown helpful, please give this video a thumbs up. It really helps other seniors find this information. And if you haven't already, subscribe to the channel and tap the bell icon. I share updates like this regularly because the rules keep changing, and I want to make sure you never miss something that could cost you. If you have a friend or a sibling who handles their own taxes, share this video with them. They'll thank you later. And I'd love to hear from you in the comments. Have you ever caught a tax mistake that saved you money? Tell me your story. I read every comment, and your experience might help someone else. Thank you for spending part of your day with me, and I'll see you in the next video.